1 day, 2 days, 3 days. 3 days of built up order flow. Welcome to Pips to Profit. My name's Cameron, and this is the previous day's high trading setup. So why is the previous day's high important? Now when I say the previous day's high, I'm also talking about the previous day's low, but for this instance, we're only going to talk about the previous day's high. It's an area that is highly looked at by large players in the market, such as banks and other large institutions. It's also an area where breakout traders will place buy stop orders to let the market trade through, and they're basically breakout traders. It's also a place for stop loss orders for people that have gone short on the previous day. Finally, it's used to quickly identify markets and other assets that have been moving in one direction for 2, 3, or 4 days. So how do I use these levels? First off, I simply don't just buy or sell at the level. The context of the market is important. I'm looking for markets that have broke out of previous day's levels at least 3 days in a row. Why do I emphasize broke out? I'm not looking necessarily for a tap or a wick. I'm looking for a day where it has broken through the previous day's level and gone higher. Or a market that has broke out of a previous day's level for 2 days, and on the third day they wick into it at a certain time of day. That could be a trade setup. Also, I like to use these previous day's levels because, like I said in the previous slide, it really helps you identify very quickly different assets and markets as you're flipping through in the morning. This is what I was talking about. You can very easily identify which markets are doing what. So you can see on a Monday they had broken out right here and broke through. See, they didn't just wick into it, they broke through and then stayed above. If they would have broke above and then came back in, that could have been fine depending on what they did the next day. And then on Tuesday, broke through again. And then Wednesday, broke through again. Basically now you have 3 days of people going long, and that's a lot of order flow built up in one direction. On the fourth day, triggering people into the market and hitting stops from people on the day before, and then how they pulled it back down, engulfed the previous candle right here, and then gone sideways. And then also looking at this pattern, and this pattern is very important because it happens every single week. In this case, you can see that they've gone up the 3 days and then they hang out above the third day's level. Now, they could put in a base here, do some kind of reset, maybe hit the previous day's low, or they hang out in this area and then tomorrow they hit the previous day's low and continue. They could do a reset. So you have to keep that in mind as well. But for today's trade setup, from the top to the bottom, I'm calling this the bottom. This is the low of the day prior to me coming to the session. This is from the London session. You know, this is a pretty big range where if you were up here in this consolidation with a theory and a thesis that they could come down and at least retest yesterday's high, you know, that's 100 plus pips that you could have gotten. So this is the same chart, but I've zoomed it in onto the 1 minute chart. Up here you can see that this blue box right here is the start of the New York session. This is 8 o'clock in the morning, New York Eastern Standard Time, and they've come up and put in a micro head and shoulders and then broke down and gone sideways. This is a breakout, pullback, and a continuation. This is 100% expansions of this low and this high. So I drag it from this low to this high, and those are targets for my trade. You have an area here where they pulled back and broke down. This is a breakout candle. I call it a breakout fake out. A breakout and they start to roll over on that candle. These are all areas of an entry. Once they break the bottom of this candle, I stop entering the market, adding, and then they roll over and I'm already taking profits off. They instantly blow through down to the previous day's high and profits are already off the table. For this trading setup, you need a market that has gone 1 day, 2 days, 3 days, okay? At least 3 days of built up order flow. The third day can be a tap depending on what time of day it is. The trade must be within my trading window or already in process. What do I mean by that? So you can see that this already hit the previous day's high and is starting to roll over, but we're not quite in my trading window. 8 o'clock starts right here. I'm already looking for the trade even though it's not quite my trading window. The trade to me is already in process. High must be traded back into in some form or variation of 3 pushes. 1 leg higher and a pullback due to that candle being engulfed by that candle right there. A second leg up engulfed by this candle, and a third leg up. This does not count because it does not break the low of this candle, okay, up into the high. I need an engulfment. They engulf right here. On this second 5-minute candle, they engulf this whole structure and go sideways. If you want to put your first entry in up here, anticipating this move, you can do that. If I were to do that, it would definitely be with a smaller size. Need to see 3 pushes back up into the engulfment. We'll go back to the 5 minutes since that's what we've been on. 1 push higher, 2 pushes higher, and the 3rd push higher, and a breakdown. Okay, this sideways consolidation gives you an opportunity to enter in somewhere up at the top or maybe on this engulfment, and they break down. Okay, I need to see some kind of chart pattern. That is a triple top to me, and it breaks down with the pin hammer. Engulfment of the whole entire structure right here and the pin hammer, and it just falls away. Real quick, I want to show you all the traps and resets on this. Works for any asset. I'm just showing you on oil because it's still really fresh in my mind. Breaking of the previous day's levels, there can be a reset of the count. So you have a break that's 2 days in, but they come down and break the low of the previous day down here. You just have to restart. So these are subtle breaks anyway. They're not very strong breaks. So you need to understand the difference between poking up through. Now, if they would have gone up here and poked through again, that might have been a really good trade setup. But in this instance where they're just kind of poking up, blown off in the direction of the trend, break down. So now you can say, okay, now we're up high. Where's the trap? Where is all of the people long trapped at? All of this area up here above this high is now trapped in the top. And also, if you look, you can see that the pattern is still in play. Traps above previous day's level. There is a head and shoulders right here. This gives you a first red day. We're up high, and now you can safely assume on the next day that maybe they're rolling over. This is a first red day opportunity where they've broke down from a head and shoulders and closed down at the lows very strong. I'm just getting at the fact that you can use these previous day's levels to help you identify markets for better trading opportunities. Same pattern, different variation. Previous day's high, broken through one time, broken through a second time, broken through a third time. Sideways consolidation. They don't follow through. There's no rollover. And we're still in an up move. There's no break in structure on a larger time frame. They continue higher, and now they've blown off in the direction of the trend and gone sideways. Trapped, they break down, and then they break down again back under the previous day's low. Hope to see you all in the comments with any feedback. You'll have a nice day.